When we hear the word investment, the first thing that often comes to mind is money. But in the world of finance and business, the meaning of investment goes far beyond just cash transactions. Investments can be anything that helps generate income or build capital, whether it's money, property, or intellectual assets like patents and trademarks. Section 1. What is investment capital? Investment capital can be broken down into two main categories: personal capital, which includes things like retained earnings or depreciation, and borrowed capital, which is money that is temporarily free, such as loans or savings from others. But remember, not all free money is an investment. It only becomes an investment when it's used to buy assets that generate income, like property or stocks. Section 2. The role of real assets and financial instruments. So, how does money become an investment? It happens when savings are used to purchase real assets or financial instruments. Real assets could include things like fixed capital, your machinery, equipment, and buildings, and intangible assets like licenses or trademarks. Financial instruments, on the other hand, include things like bank deposits and securities like bonds, stocks, or options. Section 3. The goals of investors. For investors, the main goals are usually a combination of these factors: the safety of their investments, growing their current income, and preparing for large future expenses or even retirement. Depending on their risk tolerance, some investors might prioritize safety, like government bonds, which offer low returns but are considered the safest form of investment. Others might seek high returns from riskier investments, like shares in tech startups, where the potential for growth is high, but so is the risk. Section 4. Diversification and portfolio management. To balance risk and reward, investors use a strategy called diversification, spreading investments across different types of securities to minimize risks. The goal is to ensure that no more than 5 to 10% of the portfolio is invested in any one type of security. Regularly reviewing and adjusting a portfolio is a key part of maintaining optimal returns while controlling risks. Section 5. Stock market and capital flow. Now, how does the stock market fit into this? The stock market is essentially where people offering securities, like companies issuing stocks, meet those offering capital, which are the investors. Issuers or sellers raise the money they need by selling these securities. The stock market works in such a way that the most reliable securities, those considered safe, tend to have lower yields because they're in high demand. On the other hand, riskier stocks may offer higher returns, but they're not as stable. Section 6. Suppliers of investment capital. So, who are the main suppliers of investment capital? It might surprise you that the largest suppliers are individual savers. Personal savings, whether in bank deposits, pension funds, or bonds, make up about 20 to 30% of total savings. Corporations, although they create around 60% of the investment fund, often use their earnings within the company. So, they typically act as borrowers in the investment capital market. Section 7. Role of institutions and government. Institutional suppliers like commercial banks, insurance companies, and pension funds also play a major role. Banks, for instance, may issue shares or government securities, while pension funds and insurance companies typically invest in long-term, high-yield securities. Meanwhile, local and national governments can issue bonds to attract both domestic and foreign investment. Section 8. The central bank and public debt. Finally, the central bank plays a unique role. It manages public debt by issuing government bonds, controlling interest rates, and ensuring that the government's debt obligations are met. It also keeps a close eye on the demand for these bonds and works to maintain stability in the financial system. In summary, investment capital is the lifeblood of economic growth, flowing from suppliers like savers and banks to consumers like businesses and governments. Understanding how it all works, from stock markets to savings, gives us a clearer picture of how wealth is created and sustained in the global economy. Whether you're investing in real estate, securities, or simply saving for the future, The decisions made today will shape your financial landscape tomorrow.